Welcome to the 2019 Fortune Investors Roundtable. I'm Matt Heimer. I'm the feature editor at Fortune, and I am also the editor of our annual Investors Guide. And I'm very lucky to be joined by these 5 professional investor panelists. Lori Keith is a portfolio manager and a senior research analyst at Parnassus Investments. John Linehan, chief investment officer for equity at T. Rowe Price. Catherine Wood, the CEO of ARK Invest. Ed Sim, the founder and managing partner at Bold Start Ventures, and Kate Warren, principal and investment strategist at Edward Jones. Thanks very much for joining us, and we're really glad to have you here. So the markets right now, you've got the United States stock market at very near the 10-year anniversary of a bull run. You've got unemployment at essentially a 48-year low. It's hard not to feel that you've reached the peak of an economic cycle. And so my question is, if we are at the peak, what comes next? Is it a sort of a gentle slowdown or something more severe? Kate, you got any thoughts on that?
Absolutely. I don't think we're at the peak of the economic cycle. We may be at the peak growth rate, like we saw in the second quarter of growth above 4%. But I think overall, many of the factors that have kept the economy growing and have kept the unemployment rate falling remain in place. Now, we don't expect growth to get stronger. We do expect it to sort of fade a bit as tariffs bite, as the impact of the tax cuts from this year isn't as strong next year. But we don't see this as some kind of peak. It's more we've been in this very slow, sluggish economic growth. We've speeded up a little bit. We're likely to slow down a little bit. But think of it as part of this long, extended expansion, and it just continues further as long as there aren't imbalances or something that leads to a change, a surprise.
I see. Are there adjustments that you'd be making in a broader portfolio now to adapt to that more gradual change?
2 things we'd be doing. The first is I think many investors actually need to own more fixed income, which of course is not something that's very attractive today. And when you recommend it, many people say, but I don't like the rates, I don't like owning that. But we haven't seen a lot of volatility. And one of the things that I think happens as we get late in this cycle and everybody asks the question you're asking is that we need to own more fixed income to balance portfolios and protect against volatility. Within the equity side, I'd be looking at companies that have the ability to have pricing power because we're seeing cost pressures from higher tariffs and from some of the shortages and bottlenecks in the economy. And I think companies that can pass that on are much better positioned at a time like this.
What are some companies that you see being able to do that?
I see companies like in the medical space where you've got Novartis, which of course is looking internationally, but also has the ability to keep raising prices. Now, of course, we've got concerns about regulation on that. But I'd also be looking at other types of companies that, again, have some pricing power and are able to pass on whatever higher costs they see.
I see. You were talking about the importance of fixed income. And John, I know that you do a lot of investing in the equity income space with a focus on dividend yields. What does the current economic climate do in your own strategy, and how do some of those high dividend stocks play out right now?
Well, I think, first of all, when we look at the markets and the economic cycle we're in, using a calendar as a metric to assess where you are in a cycle, I think is a very difficult proposition. Sure. Typically, bull markets don't die from old age, but they will die from either a recession or speculative excess. And right now, we really don't see either, although you start to see warning signs on both. I think when it comes to dividend paying, actually, dividend yield has been a negative factor for returns for the last several years, as people haven't had to stretch into equities in order to get fixed income with rates rising. I think over the longer term, high-yielding stocks or dividend-paying stocks have proven to be a good source of return. I think they're a very good source for a balanced portfolio. If anything, right now, we're attracted to some of the more higher-yielding stocks, which we think the market isn't properly giving investors credit for. And right now, especially companies where maybe you have some cyclicality associated with those dividends, the market on a number of companies is actually pricing in a downturn. And if we don't believe a downturn is going to occur over the next year, we think there's some real opportunities. So a company like International Paper, which almost pays a 5% dividend yield right now, has broad cyclical exposure. Unless we go into a downturn, we think they're well situated. Another company would be Las Vegas Sands, which has very strong secular growth prospects given their position in Macau and Singapore. There's a lot of investor concern around what's going on in China, rightly so. but the secular dynamics are there longer term for Macau, and you're also getting paid over 5% to wait. So those are the type of companies that we're really drawn to right now.
Makes a lot of sense. You talked about how there are only some faint signs of speculative excess in the markets, but just kind of an open question for the table. Are there places where you are seeing the kind of valuations you associate with maybe things going a little too far? I know we have a couple of tech specialists here, but Ed, any thoughts on that?
For sure. I mean, from a venture capital perspective, I've been in the business since 1996, and I'm seeing some excessive pricing, and the amount of capital being put to the market in the late stages is absolutely incredible. I think the amount of greater than $100 million rounds in the last quarter drove at least half of the $28 billion of U.S. domestic venture capital investment for Q3. So when I'm seeing pricing around 15 to 20 times 2019 revenue numbers, I start getting worried a bit. And I think that, in my mind, is a sign of excess in the markets. And I fear what may happen, let's say, in 2020 at some point in time.
Has that been reflected in the IPO market as well? I mean, with companies maybe coming to market too valuable? Or, Catherine, any thoughts on that?
What's interesting about this topic is we agree with you in terms of what's happening in the private markets, because in the public markets, what's going on is there's been a move towards passive strategies or benchmark sensitivity, which in our mind is very much the same thing. Yes. And at the same time, there's been a search for innovation in the private space, the pre-IPO world. So you have this crowding into the private world seeking innovation, and it's deserted the public world. So we think the most undervalued part of any equity market is innovation in the public equity market. So yes, we do see many IPOs that fall flat because they've just had one too many or too many up rounds in the private space. And we see incredible bargains in the public space. And many people will make fun of me when I say this, but you have a Tesla, for example, which we think long run is primarily a mobility as a service play. It's selling for 2 times revenues, 2 times trailing revenues, right? So at 45 billion versus 20 billion in sales. So in the private markets, had Tesla remained private, it would have a much higher valuation for exactly the reason you stated.
Absolutely.
Interesting. We talked about factors we look at that are kind of drivers of strong performance regardless of what the economic climate might be, and John was talking about dividends in that context. Lori, I know that's a big part of your analysis at Parnassus. Can you tell me a little bit more about some of the inherent qualities of a company that you guys think tend to drive out performance regardless of what the economy is doing?
Absolutely. So for us, it's really important to focus on both the fundamental, but also consider environmental, social governance factors. And we'll never put capital to work in a company that only has a good fundamental story. At the same token, if it is only a positive ESG story without the fundamentals, that would also not be a focus for us as an investment. We're really all about the idea of principles and performance and the integration of these 2 aspects to really create long-term alpha for shareholders. And I think when you think about the environmental social governance factors, what it does, when you think about the industry where it's come, historically environmental social governance has really meant screening out sort of the bad actors, companies that have often exposure with things like alcohol, tobacco, nuclear, gambling. But today, fast forward to where the industry is, and I think we're kind of hitting an inflection in terms of really the focus around environmental social governance in the fundamental investment process and portfolio construction, is that focusing on those factors for companies that are doing well allow you to identify really those quality compounders over a multi-year period of time. So for us, it's all about really honing in on, do these companies have exceptionally good environmental track record? Do they have independent boards? What are the factors that contribute in terms of the board diversity? And those things really do matter from a fundamental materiality perspective in the long-term performance of the company.
Tesla must be kind of an interesting call right now because the environmental logic, of course, is incredibly very much part of the mission. Governance-wise, they've had some somewhat high-profile issues, obviously. Yes. I mean, how does that calculus play out for a company like yours?
Certainly. I mean, we have looked at Tesla, and for us, valuation has been tricky from a more value investment perspective. I think from the governance perspective as well is one where we really do like to see that independence around the boards and making sure, because we've seen successful outcomes for companies that do truly have very good balance of power between boards and management teams and transparency. That does lead to better decision making over time. So that would be something we would definitely scrutinize if we were to consider that company.
Sure.
So
Please go ahead. Yeah, Kate. Oh, yeah, please. Yeah, Kate.
No, just one of the things, we don't follow Tesla, but part of the reason is their debt's junk rated. And so we wouldn't look at it until it becomes investment grade with the notion you were talking about ESG. Well, we think of that as a quality overlay that we'd look at before we even look at things like that. And it's not that they can't get there, it's that we'd rather be later and not have quite as high returns potentially, but have essentially a better track record because the company has already established the cash flows and the ability to show that bondholders are a little more comfortable that they can repay all the debt they have.
Yeah, I think in terms of the governance issue, what we've seen with visionary leaders leading innovation, whether it's Jeff Bezos or Steve Jobs or Elon Musk, is you will see behavior that is really born out of the frustration associated with short-term thinking in the equity markets. And they just don't understand how we can't understand. So that is why we have taken this long-term, a venture capital point of view in the public markets, because there are a lot of opportunities like this. In terms of transparency, I think Elon Musk thought he was being very transparent when he tweeted and felt he had material non-public information, which he probably had placed too much hope in, shall we say. So if you look at the investment itself, though, what's going to make it move is 3 years lead in chip technology, battery technology, and data collection, which is going to get it catapulted into the world, mobility as a service, that many companies are just starting to think about.
And you don't necessarily have to sell 10 million Model 3s a year to make that happen.
Tesla Model 3 is the #1 selling car in the United States if you measure by revenue. Think about that. It's never advertised. #1 selling car in the United States. They're doing something right, and they're going to go cash flow positive, we believe, within the next quarter.
Pivoting a little bit away from that, but you brought up something that I thought was fascinating that's so important to us, which is when long-term management ideals are sort of subverted and undercut by short-term thinking in the markets. I think this must apply a lot, especially for you, John, given the portfolio, the amount of the value orientation of T. Rowe Price. But I'm wondering sort of I'd love to hear from everybody, what are some short-term, or I should say, what are some long-term holdings of yours that you feel are kind of being beaten up by short-term noise?
First of all, we have a very low turnover strategy in our equity income product, which I manage. Our turnover is about 20% a year. So when we make an investment, we're really thinking about it for 5 years plus.
Sure.
There are a number of companies that we look at where we really think that the market's not reflecting either the franchise value or the asset value of the company. Oftentimes, those are companies as a value manager where there's very significant valuation appeal. And that often occurs when companies are undergoing some controversy. So names like Wells Fargo, which has been very beaten up, is in the news a lot. And you've seen its multiple compress significantly relative to its peers. But if you really take a step back and think about Wells Fargo, not in the context of today, but in the context of 3 to 5 years from now, it's still got a very strong franchise, a very defensive business model. The fact that it has not been able to grow its balance sheet, the market views as a negative right now. But if we go into a downturn, that will be viewed as very much of a positive. It typically is traded at a premium valuation to many of its competitors. Right now, it trades at a significant discount. And we think over time, the issues that are surrounding Wells Fargo are correctable in the intermediate to longer term. Another name we like a lot that fits that bill would be Dow DuPont, where the market's very focused on the cyclical exposure that Dow DuPont has right now. And a lot of cyclical companies have undergone almost a mini bear market where the valuations are down 25, 30% from their peaks. When you look at Dow DuPont, we're really attracted to the fact that the company is going to split into 3 different segments in the next 18 months. And if you look at comparable peer valuations for each one of those companies, Dow DuPont trades at a very significant discount to that. So on some of the parts story, it's very compelling. And if on top of that, the economy stays not going into recession, you've also got a cyclical kicker. But you don't really need that in order to make the investment in Dow DuPont at this point in time.
Makes a lot of sense. How about anybody else? Unloved things that you love? Unloved company that you love, I should say?
So one stock that we think looks really interesting is Xylem Corporation, which is really the largest water infrastructure technology company globally. And it's become a little bit out of favor just due to its exposure in China, as it does manufacture there and sells into that market. But we think those are transitory issues, because when you look at the company and the opportunity, the long-term secular trends associated with water treatment, water quality, we're seeing a tremendous opportunity for not only the existing infrastructure here in the United States. There's a very long tail runway of capital spending that needs to occur in our own municipalities, but also internationally. There's a very significant opportunity for greenfield projects around creating new water systems. And so, with the company really having the dominant share in this pure play water space, they have the ability to have very strong pricing power and pull through additional costs that come through. So we think they're very well positioned, both from a growth and a margin perspective over time. And from an environmental social governance, we think it does an exceptionally good job around their workplace and really creating a culture that fosters long-term commitment to innovation for this company.
Sure. Ed, you were going to jump in, I thought?
Oh, no, I'm not a public market investor per se, but I mean, I do know one stock that I know pretty well called Vonage. And I think it's interesting because there's an AOL-like cash flow part of the business. It's residential VoIP. But then there's another super fast-growing part of the business, which is driven by APIs, a la Twilio. So they bought a company called Nexmo. So if anyone actually did the fundamental analysis to understand, because we're very big into developer-led opportunities, the growth on the API side from Nexmo is absolutely incredible. So I think there's value to be had if someone can figure out the different value of the pieces there.
Catherine, I know you were mentioning having a lot of names to think of. Which one do you think, just to tie a couple themes together, what's the kind of biggest technological change you see hitting bigger, larger companies in the next couple of years, and what do you have in your portfolio that kind of excites you where that matchup is concerned?
Right. So we've centered our company around disruptive innovation. That's all we do. And there are 5 multi-trillion-dollar platforms evolving right now. So DNA sequencing, which is leading to CRISPR and other breakthroughs. Robotics, which is being turbocharged now by collaborative robots, so that's Teradyne. You've got energy storage, that's certainly Tesla. They're leading the charge, so to speak, there. There's artificial intelligence, NVIDIA, and then there's blockchain technology. These 5 platforms are actually converging. You can see it in autonomous taxi networks. That's the combination of robotics, so autonomous vehicles are robots. Energy storage, they will be electric, and they will be powered by artificial intelligence. So that's why, not to overdo Tesla, it's seen this from the very beginning and is leading the way. China is going to be the biggest market. Baidu has been deemed by the Chinese government the autonomous driving platform of choice. So they're going to get a slice of everything that happens in that very large market. Tencent is a 5% owner in Tesla, so it's got its nose under the tent there. It was the first company allowed into China without a local partner to manufacture. So just a few of the technologies that we think are going to impact every sector and every company in some way, shape, or form.
You mentioned China, and the headlines coming out of China in a sort of short-term way have been somewhat alarmist of late. A lot of concern about a gradual slowdown of that economy, although they're slowing down to numbers that we would, of course, still envy. But the combination of a slowdown, there's been a kind of a long kind of decline in the benchmark stock markets there. Kate, with your sort of broader strategic portfolio, I mean, how does news from China shape your thinking right now, or how are you looking at kind of that market within the bigger picture?
Sure. The first thing it does is the emerging markets indexes overall are in a bear market. So anytime something hits that 20% decline, you really need to say, is this going further or is this a buying opportunity because the valuations have gotten cheap? We actually think it's an attractive opportunity. Now, that doesn't mean it's at the bottom, getting back to your original concern. Yes, things could still slide further, but we think the fundamentals of economic growth, even at a little above 6%, are strong, that the Chinese government will be stepping in with additional policies to keep things better balanced, and that many people are looking at places like Argentina or Turkey and saying, oh, all emerging markets are this way. Well, no, they've really shifted to be more China-focused, more tech-focused, and if you see that growth continuing, then emerging markets actually look like an opportunity. And so we also take a longer-term perspective and say, whenever you look at valuations and fundamentals and they're positive and they're really attractive now, you don't worry too much about the fact that they could go lower short-term. You say now's the time to be stepping in.
Interesting. Thank you. We've been talking a lot about technological disruption and technological change, but I know that, John, you look a lot at some of the companies that have been disrupted and seeing which ones have kind of a rebound in them. You know, any particular names that come to mind for you around there?
Sure. You know, in large cap value land, it's very difficult to find companies that are disruptors, and we have plenty that are disruptees. But I think oftentimes the market is unwilling to give a number of these companies the benefit of the doubt or truly understand the business model. You know, if we went back 3 years ago, everyone would assume Walmart's going out of business. Amazon's going to take the complete market share, and you look 3 years later, Walmart's done a very good job of trying to basically create a moat around some of their business, focus on the brick and mortar exposure, and we think there are other companies that fit that bill as well. UPS is a company that's faced a lot of dislocation around transitioning from a business to business to consumer strategy in terms of how they deliver their packages. But I think we can all agree that the demand for delivery of packages is only going to increase. With UPS, the issue isn't so much a volume issue, it's a pricing issue. And we think that's something that can be correctable in the intermediate to longer term. Another company or collection of companies we think have been significantly disrupted are the media companies. And actually the Fox-Disney combination, we see a company that actually will have the scale to have a direct-to-consumer offering that will be very appealing to consumers, whether it's sports via ESPN, whether it's family via Disney, or whether it's the general public through Hulu. And by buying Fox, you have a very considerable collection of assets that's trading at a very attractive valuation. A third area where we see opportunity, you know, going back to energy storage, you know, if we move into electrification of vehicles, it really is going to transfer demand for hydrocarbons from oil or crude oil to natural gas. And moving those hydrocarbons is going to become a critical element of the whole energy storage and battery it's part of the story. As a result, a company like TransCanada, which is a midstream pipeline company that is one of the leaders in terms of transporting natural gas, it's trading at very attractive valuations. The market's very concerned about its ability to fund itself, is worried a little bit about the leverage. But when we look at the opportunity set in front of it, the reason it's at the leverage it is because there is a unique opportunity for this company to continue to grow and meet the further demand from electrification and other energy needs. So that would be another one where we see real opportunity.
So Matt, I think what's interesting about all of that is that technology is the underlying theme driving some of those choices, like Walmart, for example. I thought they did an amazing job of buying a technology entrepreneur in Jet.com, and then they've acquired 4 or 5 companies since then to combat Amazon. And they didn't have enough hubris to say, I'm going to do this myself. And I think some of the smarter companies are going to be the ones that say, how do I partner with the ecosystem? How do I go out and buy the technology and the engineers that I need to have to drive this disruption? So the other area that we're very excited about is investing in software engineers. If you think about it, every Fortune 500 is a technology company, or you won't be in the Fortune 500 in 5 years.
Sure.
The best engineers start companies, or they go to Facebook, Google, Netflix, and whatnot. So then how do you actually drive that innovation? You've got to buy. Or you've got to use software. So if you build on that foundation and you hire the engineers, you can actually iterate, keep up with your technology competition.
I wanted to talk about a different company, which is Dollar General. So we've got Amazon. Everybody thinks that retail is dead. But think about the fact that this company, which many people in an urban area have never been to, is mainly rural. It's 15,000 locations across the country. Half of their business is in cash. And because they're in rural areas, you're not in a situation where you're getting a few hours delivery. You're getting delivery over 3 days. And about 3/4 of what they sell is staples. So it's people who are repeating their purchases, and they may not have the income to do the Amazon Prime that gets them the free delivery. So we see this as a company where, yeah, it's a longer term view, well positioned, but everybody thinks retail's dead, except you can think about areas of the market that will be transformed, and they'll no doubt have to do different things, but where they really have something that's pretty sustainable against an Amazon type model.
I think you can make an argument that with big pharma companies, and actually with a lot of, think of this as a behemoth problem, and I'm thinking of Facebook's recent woes too. Although the economy is good, and although we've had some great business results, trust in business is not in a great place right now. And Facebook's market cap, I believe, is down about, or I should say, Facebook's stock price is down about 30% since the summer, based on continuing concerns over data privacy and and data breaches and how my information might be available and to whom. Trust is something that's hard to quantify, but how do you factor that kind of brand equity, that kind of public image into an investment decision, and what can a company do about it to make itself look better? And Lori, I know this is part of your brief, and I'd love to hear from you on this.
Sure. I mean, absolutely, brand and trust are paramount to a company's long-term success. So, for us, it's difficult to quantify, but it's something that we spend a lot of time trying to assess, which really is very intrinsic to the quality of the company and their products and services and how they're relating to their constituents, all the stakeholders, and their consumers directly. And establishing that trust is so important. And so for us, I mean, we really do try to spend a lot of time trying to make sure that the companies are really providing what they say they are, and that do deliver. Because ultimately, when you have companies that can establish that trust and brand, that gives you pricing power. Mm-hmm. So a company like Clorox, I mean, they've done a great job in terms of bringing in products that appeal to that incorporate really this idea of recycled packaging, things like that really relate to their customers and wanting to buy green products. Mm-hmm. And that's allowed them to have pricing power with these products. So it is very important.
Ed, do you have a thought about that?
Yeah, I just think it's interesting. I mean, Gartner does their emerging tech hype cycle, and for the first time ever, they horizontally put ethics and privacy as one of the big horizontal trends to look at in the next year or two. Mm-hmm. And we've been investing in GDPR-related companies, in private machine learning companies like Big ID that came out of nowhere and have already raised $40 million from the West Coast, are helping large enterprises, the Fortune 500, figure out what private data they have, where it's located, and how they manage it and secure it. And this is prepping them for the time when we as individuals should be able to go there and say, where's my data, what do you have on me, and then have the right to be forgotten, remove me from all of your lists. And I think in the next 5 years, there's an opportunity for some of these tech companies to lead the charge and say, I'm going to be the company that doesn't have your data. In fact, you own your data, and I'll pay you to get access to the data versus taking our data. And I think in the next 5 years, we'll see. And maybe there'll be a company that comes around that goes out and says, I'm going to be the next Facebook because you own your data, it's portable. And I'm seeing hundreds and hundreds of companies try to use the blockchain and other technologies to disrupt what's already out there. It's going to happen, for sure.
Yeah, Facebook, Google, Twitter, these are data aggregators. They actually do own the data, use the data. And I agree, blockchain technology, which will commoditize data and give us the power to own our own data, is going to transform that. So, as a student of disruptive innovation, I'm looking around the corner at how these data aggregators are going to be disrupted, because people are really unhappy. You can see it in the ranking of brands. That's one of the best indicators of how well or poorly a stock is going to do. If it's moving up, it's it tends to be associated with an appreciating stock. Facebook has moved down dramatically, and it is going to be difficult to recover.
Absolutely.
I think when you lose public trust, then a natural residue of that will be regulation. And the financial industry lost the public trust after the great financial crisis, and the result was Dodd-Frank, and the result was a tremendous amount of regulation. So right now, there are over 125,000 different regulations associated with the financial industry. Wow. There are just about 27,000 with the technology industry. And we think that one of the real risks within technology is the emergence of a more stiff regulatory environment for technology. And it's very difficult to quantify, but I think it very much is out there, especially as companies are starting to lose the public trust.
Actually, that's a great segue into the question that I wanted to ask each of you, which is where they see the greatest risks and opportunities in the year ahead. So I'm just going to kind of work my way back around the table, but I'll start with you, Kate. Where do you see the greatest risks and the greatest opportunities for 2019?
So I actually think the greatest risks are we're going to see more market volatility and that investors will do the wrong thing. They won't take the long view that all of us have been talking about, and they'll sell at the first moment of stocks going down. We're already seeing some signs of nervousness, and that investors really will move the wrong way at the wrong moment instead of staying invested and taking the longer term view. I see the greatest opportunity outside the U.S. We've been talking almost all about U.S. stocks, which of course is very natural, but valuations are high here. They're a lot lower in the rest of the world, and I think we could all give a long list of things that we see going wrong. All you need is a few things going right, and the rest of the world does better. And I think that's very likely to happen next year.
Ed, where do you see the greatest risks and greatest opportunities?
Sure. Well, the greatest risks, I'll look at more of a micro perspective. I think cybersecurity risks for public companies is absolutely massive. And there are certain companies that have better hygiene from a security perspective than others. So I think there'll probably be some companies out there in the next year that get hacked and lose tremendous value. On the greatest opportunity side, I'm a huge, huge believer in no matter what economic cycle we go through, is that these Fortune 500s need to invest in software. So I'm all big about picks and shovels, investing in the companies powering the developers. Look at Microsoft buying GitHub for $7.5 billion. Look at Atlassian, which is at, I think, at about a $16 billion market cap. Twilio, SendGrid, all those types of companies I think are going to power the next kind of wave of companies fighting off the Amazons of the world. So we're very bullish on those.
How about you, Catherine? Greatest risks and greatest opportunities for 2019?
Yes, so I'll echo Kate. It's been remarkable since 2008. We've seen $2 trillion of inflows into bonds and bond funds, and we've seen roughly $200 billion of outflows from equities. So I think the risk is not being in stocks. And the risk aversion out there, which to me is good news. We are not in a bubble by any stretch of the imagination. Greatest opportunities. China, we were discussing this a little bit before this session. The individuals in China do not expect privacy. They don't expect it. I don't know if they want it. You know, it's a different culture. So from an AI point of view, they are going to be able to do things that we cannot because of privacy concerns here. So we think whether it's Tencent or Baidu, you know, those are very interesting opportunities. But innovation generally, we think is highly undervalued if you've got the right time horizon and are not looking at this year's PE ratio or next year's.
Thanks, Catherine. How about you, John? Greatest risks and greatest opportunities for 2019?
I think one of the big risks for 2019 is going to be geopolitical. We clearly live in a world that is not that safe, and we're seeing rhetoric increase, and the likelihood of a policy error associated with that rhetoric, I think, has increased dramatically. So I think that's something we need to think about. Another risk that I see that really isn't talked about a lot is the potential for inflation in the markets. And really what I'm talking about is we're going to be running trillion-dollar deficits, and the market is not at all focused on that. But if you really start to think about the impact of that on the markets, it could be considerable. In terms of opportunities, as a value manager, I always think of opportunity in the context of what's cheap. And right now in the marketplace, there's very little that's actually that cheap. But one of the things that is cheap is if you look at the price, if you look at the valuation for momentum stocks, those stocks have performed well over the last year, and compared to those stocks that have performed poorly, that portfolio of high-performing stocks trades at a valuation levels that is dramatically different and far less appealing than those that have had poor performance. And in fact, the last time we saw a disparity in valuation between high momentum and low momentum that we're seeing today was back in 1999. I don't think that's the environment we're in, but that gives some people some reference or kind of a relative reference point as to the differences that we're seeing in valuation. So I'd say finding select companies that have underperformed, we feel comfortable with the business model, their ability to longer term withstand some of the secular pressures that are placed on them, that would be a good place to start.
Lori, Keith, what do you see as your biggest risks and biggest opportunities for 2019?
Sure. So I guess just starting off with the risks, firstly, I think where we are in this market cycle. I mean, we're certainly into the latter stages of a late cycle market. I mean, indications around the yield curve flattening. We're starting to see inflation not necessarily pick up dramatically, but it is starting to pick up. We're seeing inflationary costs around wages. Oil prices are rising. So all those things are being factored into driving higher cost, and concerned about slowing in earnings going forward, and where valuations stand today certainly creates risk around the broad market. Now, where we see the opportunities, really looking at a bottoms-up sort of fundamental approach, really at the individual company portfolio level, we see opportunities for companies that really do have what we characterize as durable moats, that have these quality characteristics that can withstand even a down part of the market cycle, because we've only been in one part of the market cycle since 2009. And while people forget that we do still have cycles, we want to make sure that investing in quality companies that have wide competitive moats, increasingly relevant products and services that play into many of the technological trends that we talked about, well-managed companies, along with very socially responsible companies, are going to be able to outperform over the long run.
Thanks, Lori. Thanks so much to all of our panelists. It's been great to have you all here, and we're so grateful for your insight, and we'll see how next year goes.
Great.
Thanks.
Thank you.
Thank you.
Thank you very much.